Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. All right, good morning. Interesting day out today for Friday, July 8th, 2022. So we got a jobs number this morning that was really good. It was very healthy in terms of employment. Problem is, it was a little too healthy in terms of inflationary. New jobs came in, I think 100,000 more than was expected. So by that, just by its very nature, all else being equal, more people being paid higher wages is by itself inflationary. You've got more consumers out there purchasing goods and services throughout this great nation. That's the rub. So you got futures pulling back, NASDAQ down the most. It was down about 1%, I think, off that print. I don't know if it's still right around there, but that's definitely the worst of the lot. Dow's not down that much, and S&P somewhere in the middle. But speaking of tech, speaking of the NASDAQ, the triple Qs yesterday broke a downtrend that's been in place since April. So if you look at the charts back in April, triple Qs hit their head on the 200-day moving average and really haven't looked back. Been spiraling down ever since in a pretty delineated downtrend. It broke that downtrend yesterday. So you can draw the line yourself. We're going to get a bit of test of that today, perhaps. I mean, for me, that number on the triple Qs is right around 290, 289 is kind of that number it would need to hold to keep that breakout to the upside of that downtrend intact. So it's something to watch there for sure. We talked about financials yesterday. We talked about notoriously bearish folks getting more constructive. Doug Cass, Danny Moses. Doug Cass to the point where I think he actually owns a lot of these assets. Danny Moses pointing out that maybe he's condoning purchasing some of these, but they are bid this morning, and I don't know if that's on a slight resurrection of the yield curve after this job print or what, but they are bid a bit. XLF is bid. Goldman Sachs looking up 1%. JP Morgan, Morgan Stanley, B of A, you name it, they are bid a bit here in the pre-market. Interesting. And maybe it is setting up for a buy the news event next week when they start reporting earnings. Absolutely nobody's looking for great numbers out of these guys. Capital markets has just been a complete disaster recently. There's been absolutely no deals done whatsoever. So no one could be looking for good numbers, but maybe people are feeling like a lot of the pain is baked in for those stocks. So keep an eye on those. We do own Goldman Sachs here. We do own B of A. We added to Goldman. We added yesterday, day before, something like that. We will add again, but probably not until after the print. See how that comes out. An upgrade this morning on Morgan Stanley. I like this one. XPO, quality freight company. Stock's gotten absolutely crushed this year. Current valuation is under 9 times forward earnings. 8.8, I think, is what I just pulled up. And they're trading for under 1 time sales. So the upgrade is arguing that the current valuation is discounting a 50% hit to earnings, which Morgan Stanley doesn't feel is going to happen. That sounds right. For me, it's cyclical, so those kinds of things are not so much on my immediate. They're on my radar, but not on my buy list here near term, because I do think there's got to be more pain and more blood in the streets for those types of stocks. But that being said, at this current valuation, and they've got a catalyst coming up in that they're spinning off their brokerage and forwarding business. So you put all that together, it is compelling, I think, at this kind of valuation. So that is one I think that makes sense to nibble on. We don't own it. Again, it's on our radar list. Have not pulled the trigger yet. Going to watch. Certainly not going to buy it today, gapping up 4% on the upgrade or whatever it is. But something to watch. Quality asset on sale. Right in the crosshairs though of economic slowdown. So there is that. But that's something I wanted to point out. I think that's all I got. Have an awesome weekend and see everybody on Monday.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.